Hey everyone, Trump's new tax law is officially here, and if you're retired or getting close to retirement, the next 4 years could be the most important tax planning window of your lifetime. Now, I know that sounds dramatic, but here's why I'm saying this. Buried in this legislation are provisions that expire at the end of 2028, and that means you have exactly 4 years to take advantage of what I believe are some of the most powerful tax-saving opportunities we've seen for retirees in decades. And the decisions you make during this window or the decisions you don't make could literally cost you tens of thousands of dollars over the course of your retirement. In this video, I'm going to break down exactly what's changed, what it means for your specific situation, and most importantly, what you need to do right now to make sure you're not leaving money on the table. Now, before we get into the details, make sure you download my free guide, The Retirees Tax Planning Roadmap for 2025-2028. This guide is going to walk you through the exact steps you need to take year by year to maximize this 4-year window. It includes planning worksheets, decision trees for Roth conversions, and a timeline that shows you when to take specific actions. You know, I've seen too many retirees miss opportunities like this simply because they didn't have a clear action plan, and this guide is designed to prevent that from happening to you. You can grab it using the link down in the description. So look, there's a lot in this new tax legislation. We could spend hours talking about the changes to estate tax exemptions, the modifications to corporate tax rates, the new small business deductions, or even the adjustments to capital gains treatment. And all of that matters to different people in different ways. But today I want to focus specifically on the provisions that create the biggest, most immediate planning opportunities for retirees. And that means we're going to zero in on 3 main areas. First, the enhanced standard deduction and what it means for your taxable income. Second, the new senior deduction that's only available through 2028. And third, and this is the part most people are missing, how these changes create a once-in-a-generation window for strategic Roth conversions and tax-efficient withdrawal strategies. But you know, really before we dive into what's new, I think it's important to understand what we just avoided, because that context makes these changes even more significant. Until this law was passed, we were headed for what I call a tax cliff at the end of 2025. All of those tax cuts from 2017, the ones that lowered your tax brackets and increased your standard deduction, were set to expire. And that would have been a massive problem for retirees. The 12% tax bracket was going to jump back up to 15%. The 22% bracket would have gone back to 25%. The 24% bracket back to 28%. And it wasn't just the rates. The standard deduction was going to get cut nearly in half, and personal exemptions were coming back, which sounds good, but actually would have resulted in higher taxes for most people. According to the Tax Foundation, about 62% of Americans would have seen their taxes go up. And for retirees who are living on fixed incomes and trying to make their savings last 30 years or more, that kind of tax increase could have been devastating. So the first piece of good news is that this new law makes those lower tax brackets permanent. You don't have to worry about them expiring anymore. The 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets are now locked in, and they'll continue to be adjusted for inflation every year. And the same goes for the higher standard deduction. It's now a permanent part of the tax code. But here's where it gets really interesting, and this is what most of the media coverage has completely missed. The new law doesn't just extend the old provisions. It actually enhances them for retirees, and it does so in ways that create very specific planning opportunities that are only available for the next 4 years. Now, I want to hit the pause button here for just a moment because before we talk about what's new, we need to make sure everyone understands how the standard deduction actually works in your overall tax picture. You know, I've worked with hundreds of retirees, and I can tell you that this is one of the most misunderstood parts of tax planning. People hear standard deduction and their eyes glaze over, but this is actually the foundation of everything we're going to talk about. So let's take 60 seconds to break this down in a way that makes sense. Here's how your taxes actually get calculated. You start with your total income, and that includes everything. Your Social Security benefits, your pension if you have one, withdrawals from your traditional IRA or 401k, interest, dividends, capital gains, rental income, everything. Then you subtract what are called above-the-line deductions. These are things like contributions to a health savings account or traditional IRA contributions if you're still working. What's left after those deductions is your adjusted gross income, or AGI, and this number is really important because a lot of other things in the tax code are based on your AGI, like Medicare premium surcharges and the taxation of Social Security benefits. But we're not done yet. From your AGI, you then subtract either your itemized deductions, things like mortgage interest, state and local taxes, charitable contributions, or you take the standard deduction, whichever is higher. And for most retirees, especially after the 2017 tax law changes made the standard deduction so much larger, you're going to take the standard deduction. and whatever's left after you subtract that standard deduction, that's your taxable income. And that's the number that actually gets run through the tax brackets to figure out how much you owe to the IRS. So here's the key insight. The standard deduction is essentially a tax-free zone. It's the amount of income that the government lets you receive every single year without paying a penny of federal income tax on it. No forms to fill out, no receipts to save, no complicated calculations. It's automatic. And the bigger that standard deduction is, the more income you can receive tax-free. And that's why the changes in this new law are so significant for retirees. So let's talk about what's actually changed with the standard deduction, because there are actually multiple layers here, and you need to understand all of them to see the full picture. First, starting in 2025, the base standard deduction is going up by $500 for married couples filing jointly and $750 for single filers. So that brings the standard deduction to $31,500 for married couples and $15,750 for single filers. Now, that might not sound like a massive increase, but remember, every dollar of standard deduction is a dollar of income you don't pay federal taxes on. But there's more. If you're over the age of 65, you've always been entitled to an additional standard deduction on top of the base amount, and that's still in place. For 2025, that additional amount is $1,600 per person if you're married filing jointly, and $2,000 if you're single. So let's do the math on this. A married couple, both over 65, filing jointly will have a standard deduction of $34,700 in 2025. That's $31,500 base, plus $3,200 for the additional age-based amount. And a single filer over 65 will have a standard deduction of $17,750. Now that's substantial on its own, and it means that a retired couple could receive nearly $35,000 in income and pay zero federal income tax. But we're not done yet, because what I just described is the enhanced permanent standard deduction. What we haven't talked about yet is the temporary senior bonus deduction that was included in this new law. And this is where things get really interesting for tax planning purposes. So here's the big new provision that everyone needs to understand. Starting in 2025 and running through 2028, there's an additional deduction of $6,000 per qualifying individual over age 65. This is completely separate from the standard deduction we just talked about. For a married couple where both spouses are over 65, that's an additional $12,000 in deductions every single year for the next 4 years. Now, let me be very clear about how this works, because I've already seen some confusion about this in the media. This senior bonus deduction is available whether you itemize or not. If you itemize your deductions, you add this $6,000 or $12,000 on top of your itemized deductions. But for most retirees who take the standard deduction, and that's going to be the vast majority of you watching this video, this bonus stacks right on top of your standard deduction. So let's put all the pieces together and see what this means in real dollars. For 2025, a married couple, both over age 65, taking the standard deduction, will have a total deduction of $46,700. Let me say that again, $46,700. That's $31,500 for the base standard deduction, $3,200 for the regular over 65 increase, and $12,000 from the new senior bonus deduction. Think about what that means. A retired couple could receive $46,700 in income in 2025 and pay absolutely zero in federal income tax. And if you're single and over 65, your total deduction would be $23,750. Now, I want you to really sit with that number for a second, because this is where the planning opportunities start to become clear. But there are some important limitations you need to know about. The senior bonus deduction starts to phase out once your adjusted gross income hits certain thresholds. For single filers, that phase out starts at $75,000. For married couples filing jointly, it starts at $150,000. And here's how the phase out works. For every $1,000 your AGI exceeds those thresholds, your senior bonus deduction is reduced by $100. So if you're a married couple with an AGI of $160,000, you're $10,000 over the threshold, which means your $12,000 senior bonus deduction gets reduced by $1,000, leaving you with $11,000. Now, depending on your income level, you might be thinking, well, this doesn't apply to me because my income is too high. But hold on, because this is where strategic planning comes in. Your AGI is something you can control to some degree through the timing of your income, and we're going to talk about exactly how to do that in just a minute. But first, I need to emphasize the most critical part of all of this. This senior bonus deduction is only available from 2025 through 2028. After December 31st, 2028, it goes away. You're looking at a 4-year window, and that's it. And this is not something that might be extended. This is not something you can count on Congress to renew. When this law was written, this provision was specifically designed to be temporary. So you have 4 years, and what you do with those 4 years could have a massive impact on your lifetime tax bill. So let's talk about how to actually use this window. The first and probably most powerful strategy is Roth conversions. Now, if you're not familiar with Roth conversions, here's the basic idea. You take money out of your traditional IRA or 401k, you pay taxes on that money now at today's tax rates, and then you move that money into a Roth IRA where it can grow tax-free and be withdrawn tax-free in the future, and you never have to take required minimum distributions from a Roth IRA. Now, the reason Roth conversions are so powerful during this 4-year window is because of that enhanced standard deduction we talked about. Let me give you an example. Let's say you're a married couple, both over 65, and your normal annual income from Social Security and a small pension is $40,000. With a standard deduction of $46,700, you're not even using your full deduction. You have about $6,700 of unused standard deduction that's just going to waste. But what if, in addition to your $40,000 of regular income, you did a Roth conversion of $30,000? Now your total income for the year is $70,000. You subtract your $46,700 standard deduction, and your taxable income is $23,300. That entire $23,300 is taxed at just 10%. You just converted $30,000 to Roth and paid only about $2,300 in federal taxes. That's an effective tax rate of less than 8% on that conversion. And here's the thing, you can do this every single year for the next 4 years. That's potentially $120,000 that you could move from traditional IRA to Roth, paying very low tax rates and setting yourself up for completely tax-free income later in retirement. And this is especially powerful if you're in your early to mid-60s and haven't started taking Social Security yet or taking required minimum distributions. You have a window right now where your income might be lower than it will be in a few years, and you can use that window plus the enhanced standard deduction to get money into Roth at the lowest possible tax cost. The second strategy that this window opens up is what I call tax gain harvesting. Now, most people have heard of tax loss harvesting, where you sell investments at a loss to offset gains. But tax gain harvesting is the opposite. It's intentionally selling investments that have gone up in value to realize those gains while you're in a low tax bracket. Here's why this matters. If you have investments in a regular taxable brokerage account that have appreciated over the years, you have what's called unrealized capital gains. When you eventually sell those investments, you'll pay capital gains tax on the profit. But here's the thing, for 2025, if your taxable income is below $96,700 for married filing jointly, or $48,350 for single filers, you pay 0% on long-term capital gains. So let's go back to our example couple with $40,000 of regular income and a $46,700 standard deduction. Their taxable income before any capital gains is zero. They could realize up to $96,700 in long-term capital gains and pay 0% federal tax on all of it. And when they sell those appreciated investments and immediately buy them back, they reset their cost basis to the current market value. That means if they sell those same investments years later, they'll only pay tax on the gains from this point forward, not on all the gains they just harvested tax-free. The third major planning opportunity is income smoothing, and this is something that too many retirees overlook. A lot of people, they retire, and they just kind of let things happen to them from a tax perspective. They wait until they're 73 to start taking required minimum distributions. They claim Social Security whenever feels right. They take money out of their IRA only when they need it for a specific expense. And what ends up happening is their income is really uneven from year to year, and they end up paying higher taxes than they needed to over their lifetime. But with this 4-year window and the enhanced deductions, you have an opportunity to be much more strategic. Instead of waiting for RMDs to force you to take large distributions later, you can start taking smaller strategic withdrawals now while you have this large standard deduction to shelter the income. You can spread your tax liability out more evenly. Avoid those big spikes in income that push you into higher brackets or cause your Medicare premiums to go up, and you can reduce the size of your traditional IRA so that your future required minimum distributions are smaller and more manageable. Now, here's where this gets complex, and this is why you really need to run the numbers for your specific situation. All of these strategies, Roth conversions, tax gain harvesting, income smoothing, they all interact with each other and with other parts of your tax picture. You have to think about the taxation of Social Security benefits, which is based on your provisional income. You have to think about Medicare premiums, which can go up if your income crosses certain thresholds. You have to think about the phase out of that senior bonus deduction if you're close to those income limits. And by the way, we haven't even talked about some of the other provisions in this law that might affect you, like the changes to estate tax exemptions, which matter if you have a larger estate, or the modifications to charitable giving rules, which could create opportunities if you're charitably inclined, or even the expanded SALT deduction limits, which are also only available through 2028 and could be huge for those of you in high tax states. There's a lot of layers here, and every situation is different. You know, there's really a lot of paths we could go down with this planning. If you're 60 to 65 and not yet taking Social Security, you might have a completely different strategy than someone who's 70 with required minimum distributions already happening. If you have a pension, that changes the equation. If you have substantial assets in a taxable brokerage account versus everything in an IRA, that changes the equation. If you're healthy and expecting a long retirement versus if you have health concerns, that changes the equation. The point is, there's no one-size-fits-all answer here. But what is universal is that this 4-year window is not something you can afford to ignore. The worst thing you can do is get to January 2029 and realize you missed the opportunity. So here's what I want you to understand. We're now in 2025. That means you have 2025, 2026, 2027, and 2028. 4 years. 4 chances to take advantage of these provisions, and every year that passes is one less year you have to act. If you wait until 2027 to start thinking about this, you've already wasted half the window. If you wait until 2028, you've got 1 year to execute a strategy that really should be spread out over multiple years. So what should you do right now? First, you need to know your numbers. What's your current AGI? What are your income sources? How much do you have in traditional IRAs versus Roth IRAs versus taxable accounts? What are your projected required minimum distributions going to look like in 5 or 10 years? If you don't know these numbers, you can't make a plan. Second, you need to run projections, and I don't mean rough back-of-the-envelope math. I mean actually running different scenarios to see what happens if you do X amount of Roth conversions each year, or if you harvest X amount of capital gains, or if you delay Social Security to create a wider conversion window. You need to see how these pieces fit together. Third, you need to actually execute. And this is where a lot of people fall down. They understand the concepts, they know they should do something, but they never actually pull the trigger. They overthink it, or they wait for the perfect time, or they just get paralyzed by all the options. Don't let that be you. Done is better than perfect here. A good plan executed now is better than a perfect plan that never happens. Now, if you're sitting here thinking, this all makes sense, but I don't know how to do this for my specific situation, that's completely normal. This is complex stuff, and it's exactly why I work with clients on comprehensive tax planning strategies. If you want to talk about your specific situation and see how these opportunities apply to you, you can find out how to get in touch with me and my team down in the description. We'll walk through your numbers, run the projections, and build a year-by-year action plan for this 4-year window. But whether you work with me or someone else, or you tackle this on your own, please don't let these 4 years slip by without taking action. You know, I've been doing this long enough to have seen what happens when retirees miss opportunities like this. I've seen people who could have converted hundreds of thousands of dollars to Roth at low tax rates, but they didn't, and now they're stuck taking massive required minimum distributions and paying 22% or 24% or more in taxes. I've seen people who could have harvested gains tax-free and reset their cost basis, but they didn't, and now they're facing big tax bills when they need to sell investments to fund their lifestyle. I've seen people leave literally tens of thousands of dollars on the table simply because they didn't have a plan. And I don't want that to happen to you. This 4-year window is a gift. It's a chance to take control of your tax situation in a way that most retirees never get. The tax law has created this opportunity, and now it's up to you to decide what you're going to do with it. Are you going to be proactive? Are you going to run the numbers, make a plan, and execute over the next 4 years? Or are you going to look back in 2029 and wish you had? So don't wait. Download the free guide I mentioned at the beginning, the Retirees Tax Planning Roadmap for 2025-2028. It's going to give you the framework and the action steps you need. Talk to your financial advisor, talk to your CPA, and make sure they're aware of these provisions and how they apply to your situation. And if you don't have someone who's helping you with proactive tax planning, that's a problem you need to fix now, not later. The next 4 years could be the most important tax planning window of your retirement. Make them count. Thanks for watching, and I'll see you in the next video.